This morning, the United States and Israel launched coordinated strikes against Iran. Markets are reacting, and they're going to react through the week. Oil is moving, futures are volatile, headlines are aggressive. It's been a crazy day. The question, though, isn't political. The question is, what does this mean for your portfolio or mine? Let's strip away emotion and look at the mechanics of this whole thing. Quick disclaimer though, this is for educational entertainment purposes only. I'm not a financial advisor. We're just here discussing how markets respond to geopolitical conflict, not providing political commentary or investment advice of any kind. Now, let's break it down logically, right? So it's a lot to digest. When major geopolitical events happen, step one is volatility. Markets hate uncertainty more than they hate bad news. So we typically see things like futures dropping initially, volatility index spike, defensive sectors rotate upwards. But the first move is usually emotional, right? Institutional positioning often comes later. But here's the domino that most people don't understand. This isn't about stocks first. It's about oil. Iran sits near the Strait of Hormuz, and roughly 20% of global oil passes through that region. If that corridor is threatened or disrupted, oil prices are going to spike. And when oil prices spike, inflation pressure rises. Consumer costs increase, central bank expectations shift, airlines and transport stocks fall. This is how regional conflict becomes global market volatility. The transmission change is conflict, oil, inflation, interest rate expectations, and stocks. And that's what most investors should monitor. Historically, in early stage conflict, energy stocks rise, defense contractors rise, gold may rally, utilities may hold steady. What about growth stocks? They often see short term pressure. But here's the key, these rotations are often temporary. Markets eventually revert to fundamentals: earnings, rates, liquidity. Now, here's the part long term investors need to hear though. Look at the past geopolitical shocks: Gulf War, Iraq War, Russia and Ukraine invasion. Markets dip initially, volatility spikes. Then, over weeks or months, focus shifts back to fundamentals, right? Corporate profits, economic growth, monetary policy. Long term charts show geopolitical events rarely permanently derail major equity indices. They create disruption, not extinction. Personally, I'm watching oil above key resistance levels, bond yields reacting to inflation risk, dollar strength, margin exposure levels, and credit spreads. Notice what's missing. I'm not reacting emotionally. If volatility rises, that can mean discounts, rebalancing, opportunity, but only if you're not overextended already. And this is exactly why in my previous videos I simplified my portfolio last week. I'm controlling margin and I paid off almost all of it. I'm diversifying internationally with VXUS, and I did that recently. I'm buying dividend stocks for bridge income, because if your portfolio structure is disciplined, headlines don't derail your plan, they test it. And we knew this was coming. They hinted at this way before it happened. The road to $1 million isn't built in calm markets. It's built by surviving volatile ones, right? Markets react, and they will react. Oil will move. Headlines will escalate. But disciplined investors do not make permanent decisions based on temporary events. Conflict creates uncertainty, and it always will. Uncertainty creates volatility. Volatility, though, creates opportunity for those that are prepared for it. The key is control your leverage, stay diversified, watch oil, watch bonds, and ignore the panic. That's how you build wealth through chaos or through times like this. If you want calm investing perspective during volatile times, subscribe. If you're building long-term wealth and you're not trading headlines, stay disciplined. I definitely want to hear from you though. Comment below, are you buying this volatility or are you waiting?